thank you very much, Ingrid and Bjorn, for having us in this conference. That yesterday we had a fantastic day, and we learned a lot about blockchain, right? And one of the big messages is that I think the feeling that we all share that there's going to be a lot of changes, right? Market structures will be replaced and changed, new players emerge, but hopefully this will not just mean replacement of one technology with the other, but this will also gives us an opportunity to think about, are we doing things right in this market design that we currently have, and if not, how should we be changing it, right? So in this paper, we're going to be thinking about market design options in a particular area of market microstructure, the area of post-trade settlement. So the motivation comes from this fact that we have this very visible discrepancy, and this is one of the first applications of blockchain that Kem Harvey yesterday pointed out, right? We have trades that are executed at fast, in fact, very fast speed, right? So here I have this picture from Albert Mankfeld's paper that shows 30 trades executed within 1 millisecond for Comcast. And at the same time, so trades are being done very fast, and at the same time, we have this 3-day settlement, right? So we're now in T+3 in the US, and only in 2016, SEC has announced that it will change from T+3 days to T+2 days, right? So trade date plus 3 days, that's when the actual ownership change takes place. So why do we have this discrepancy? Well, partly it's kind of the institutional rigidity of the current system and the technology that is being used, right, and inertia on behalf of the regulators too. There are a lot of fixed steps, and I will show you exactly all these fixed steps. And at the same time, we have this blockchain technology that is emerging, that is much more flexible, and there are new players that started already using that technology for settlement. So let's explore the options that we have potentially here. And why SEC is even moving from this T+3 to T+2, and this will actually come in effect this September. Well, one of the reasons is that counterparty risk and fails to deliver is still $1 billion problem. So this graph gives you a box plot of daily volume, dollar volume of fails to deliver, and you see that on average, in good times, it's around 2 billion per day, but in bad times, it can triple, right? It can multiply. So we had an average daily volume of around $6 billion trades that just don't go through. Okay, so at the same time, we have this beautiful technology, and I'm not going to go through this 101 because yesterday was the 101 basically, right? So, but importantly, hopefully you all remember that this was a ledger, right? A ledger that can allow trust between the parties that don't normally trust each other, right? So the economists called it the trust machine. So because it's immutable, it's this cryptographically very smartly secured, it can potentially allow for short settlement chain. In fact, if people are talking about T0, right? So settlement could be almost immediate. And here comes a graph that shows you how we are settling assets now, right? So there are a lot of ledgers involved in this transaction and a lot of trusted parties, precisely because the buyer and the seller don't necessarily trust each other, right? So we have the custodian banks that safeguard the assets. We have the central depository that does the actual exchange of the ownership, records it, and we have the CCP that provides the netting. And what blockchain can allow to do is essentially collapse all these ledgers into one ledger, right? And this immutable shared record of all the transactions. So do we want the settlement to be immediate? That's kind of the first question that we should ask ourselves. And we actually have a precedent in the sense that Moscow started or had already immediate settlement. It was not with blockchain technology, right? But they basically forced the delivery immediately. And they reversed it, going on the delayed one. And kind of the most the reason that was pointed out mostly that it was just very costly for the traders. You want to sell the stock, you actually have to deliver it immediately, so you have to get it from somewhere, you have to borrow it, you have to own it, right? You can't wait for the opposite sign of train, you can't do this kind of obvious netting. So you have to, there are inventory costs or funding costs involved in this. When you look a little bit more detail beyond this hype, okay, we should all go to T0, there are actually more nuanced industry positions, okay? So people talk about flexibility of settlement. And in particular, Fredrik Vosk, the VP of Blockchain Innovation at NASDAQ, talks about the participants being able to select when they want to sell, right? Depending on their trading needs and on their funding needs. And we had the example of Australian Stock Exchange yesterday, right? When Camp Harvey said that it looks like Australia will be the first one to transfer on this blockchain settlement. And this is exactly along the lines that they're also thinking. They're saying, well, customers can choose when they want to sell. It doesn't have to be T+2 or T+3 or T0. Why don't we kind of allow more flexibility? And I like particularly the quote from Chris Church. He's with Digital Asset, and that's the company that works with Australian Stock Exchange. So he calls it T when you like it, okay? It doesn't have to be a particular set time. So this is where our paper basically comes in. We ask these questions, and we are economists, right? We want to, before we go in and implement these reforms, we want to think about how this could potentially go wrong or how this could be better than the other alternative. So the first question that we ask is, when would you like actually to have immediate settlement? It's kind of the hint that we get from the Moscow example that not in all situations you would like to settle immediately. Then we recognize flexible time to settlement as an option. And well, it's an option, so who should be exercising it? In a sense, should this be the exchange or the trading platform, if you're talking about OTC market, that sets this unique time to settlement for a particular asset for a particular date? It doesn't have to be fixed, can vary with market conditions, right? Can vary day by day depending on the situation the markets are in, but it's kind of set for all the participants. Or should it be the traders, right? Should we maybe allow, now we have this contract that has the quantity and the price, but maybe the settlement should be the third dimension. Why not? You agree on three things, on quantity, price, and time to settle, right? So it's kind of, you can think about it as three-dimensional order book. So our approach, we are not only economists, but we're also theorists, right? So this will be a model. Our approach is to view this as a model of a specialist market, and we introduce the frictions that we think are relevant and kind of given this industry discussion which seem to be relevant. One is the counterparty risk. I show you counterparty risk is important. You saw this fails to deliver data. The other friction that we'll have is the surge cost, and this will allow us to model this inventory management cost that I talked about, right? That actually to deliver immediately you have to hold the asset, okay? So this will be embedded into this surge cost. And the last friction will be the imperfect competition. So the first two will allow us to give the answer to the first question, and all three of them will allow us to give the answer to the second question. So let me just give you an overview of very quickly so that you see the papers that are in the literature. The list is in the paper. So this blockchain in finance, if you're interested in it, it's really growing, right, day by day. There are new papers emerging. And we will see one more here today from Katja and Andres, also at University of Toronto. So let me quickly tell you about the model and just basically the intuition. I will try to keep it very, very simple. So we have a riskless asset where we abstract completely from the market risk here. And we have buyers, okay, who have different valuations for that asset. So there will be a unit measure of those buyers, and they arrive at the market and they want to buy, and because they have the private value or the hedging shock or liquidity need, whatever. And we will have these two intermediaries that will compete with each other. And there will be a large number of sellers. So this table kind of outlines you pretty much who holds what. So basically, for simplicity and without loss of generality, that just allows us to focus on one side of the market, we assume that sellers really have negative valuation. So their asset value is zero, okay? And this can be easily relaxed. This is not a big assumption. So the intermediaries do value the asset at V, at its kind of fundamental or true value, if you will. And the buyers have a higher valuation of the asset. So in terms of holding, sellers hold the assets, buyers don't. We also allow the intermediary to hold the asset, and this is just so that we have immediate settlement actually being feasible. We could relax that by saying that the intermediary can go and borrow the asset. Okay, so in some sense, we underestimate the cost of immediate settlement here. We allow the intermediary to hold it, but you can see very clearly from here that there are gains from trade if the intermediary actually does what it's supposed to do, matches buyers and sellers. And let me just very quickly mention that there is a room for intermediation here because the buyers and sellers don't have matching trading needs, or they don't arrive on the market at the same time, so you still need this kind of matching technology, and this is exactly what the intermediary will be providing. So in terms of the timeline of the model, the contract will have price and time to settlement in it, right? And at the beginning, we will be exploring two options. At the beginning of the model, at t-2, it's either the exchange. Remember, I said that we will analyze these two designs. One is that the exchange sets time to settlement, and the other that intermediaries set it. So at t-2, time to settlement is set by either exchange or the intermediaries. Then prices are set, then the buyer arrives, okay, and enters this contract with the intermediary. And between the buyer arrival and the settlement, two things can happen. So the intermediary searches for the seller, zero valuation seller. That would be the best case scenario for him if he finds someone who can actually buy the asset for zero and just transfer it to the buyer. Okay, so you should think about this as really this inventory management cost, right? So he would like to not to spend his own money, but he would like just to provide this matching service. And then another friction, so this is the search cost friction that I talked about, or inventory management friction. And another friction is that intermediary can default. Okay, so we have this counterparty risk embedded on it, which basically means he fails to deliver on this particular trade. Okay, and here just very quickly pointing out that we do have this price paid up front in this presentation that I will show you. So price is paid by the buyer at T0, but everything, so it can be easily relaxed to have the delivery upon payment that perhaps you would be more comfortable with. And nothing really changes in terms of our settlement results because price is just the transfer. So this risk shifting situation when you have delivery upon payment, that buyer doesn't worry that he has to pay and he doesn't get the asset, this risk shifting will be fully absorbed by prices. So all the results kind of go through. The mathematics is just a little bit prettier, so we kept it like that. First, before we go into the equilibrium, let me just try to show you what will be the first best, kind of the best scenario that the social planner who minimized the total surplus in the market would do. And here we have the total surplus. It depends on the probability that the trades go through, right, that there is settlement, and also on the conditional gains from trade. And from here, maximizing this, we can solve for the optimal time to settlement. And the intuition is that this is my plot of this trade surplus, right? We saw that there are gains from trade, so there is trade surplus. And you see here that it's concave in time to settlement. So there is actually an interior solution, which means that delayed settlement will be actually optimal in this situation, okay? And when will immediate settlement be optimal? Well, very intuitively, if you have higher counterparty risk, right? So if the market level of the counterparty risk rises, shifts, then you would want, you go to the corner solution, and immediate settlement would be optimal, okay? And it actually also depends on the buyer's valuation of the assets. So buyers who value the asset more would prefer this immediate settlement earlier, kind of for when market is still in relatively good times. But buyers who have lower valuation, right, this blue line over there, they don't care so much. They could delay settlement and pay less for it. Okay, so what happens here is that in order to deliver immediately, as I pointed out a couple of times, the intermediary needs to hold this asset, right, which is costly. He would prefer to get it from the zero valuation seller. And where this cost ultimately gets passed on to the end buyer, right? So we can see what happens with prices here. So, let me walk you through these three lines here. So the red line shows the price as it changes with the kind of market default rate. And this is the standard situation that we are now in. That's the fixed settlement, T+3 or T+2. So we see that as the default rate increases, this price decreases, and that's natural. If you have fixed time to settlement and default rate rises, you want to be compensated. So you want to be compensated for taking the risk, so you pay less for the asset. Okay, but the situation that is an alternative is this T0, and that's actually the highest price that you would pay. Right? It's expensive to deliver this T0 settlement. And it's particularly clear what the difference is and what the cost is if you compare it to the blue line, which is our situation with the optimal time to settlement. You see the price actually increases in the default risk, and that's precisely because as default risk increases, T actually drops, so intermediaries start settling faster, and it's costly to settle faster, so he charges more, okay? So the blue line is increasing, but it's still below the dashed one, okay? So the bottom line from here, immediate settlement is not always optimal. It's optimal for high kind of default risk situations, high counterparty risk, right? So bad times, think about it like that. And it's also not just it's not optimal, it's costly, and this cost is passed on to the buyer, okay? So now that we analyze this situation of kind of first best case, we can go on to our competition. And the same trade-offs would carry through there with kind of additional layer that the two intermediaries will be competing between each other. So we have these competitive contracts, and without loss of generality, so ex ante, the two intermediaries are identical. But I will show you and explain the intuition that it's not optimal for them to offer the same time to settlement. So they will actually offer different T's, different time to settlement. So without loss of generality, let's call the L the longer time to settlement intermediary, or the lower quality, as I will refer to him. And we will have the second one offering shorter time to settlement. So TH is shorter than TL. So this will be the other intermediary. And there will be an indifferent buyer, of course, who does not care and can buy the asset from either of the two intermediaries providing the service. And the buyers with high evaluation will go to the high quality intermediary because they really want the asset and they want to settle faster. The rest will go to the low quality intermediary. And we will have these kind of important state variables that reflect these two frictions that are happening. One will be the survival probability, and the other will be the marginal cost or the payment cost differential between the two intermediaries. So what is this all about? Well, remember that these two intermediaries were ex ante identical, but of course, once they choose their settlement time, they kind of endogenously choose how safe they are, right? That's one thing, when will they default? And they also endogenously choose how costly it's them to deliver this asset. This cost is here. It's this basically expected payment. You lose V if you deliver yourself, if you don't default, and also if you don't find a zero valuation seller. Okay, so this is like a marginal cost of delivering that asset. And here we basically illustrate that these kind of differences between these two intermediaries are non-trivial, right? The difference in cost is actually non-linear. So let me now kind of try to give you the intuition for the equilibrium. So we see here, this is a delayed settlement equilibrium in which both intermediaries actually offer delayed settlement. Nobody goes for T0. And why is that? Well, remember we had these two frictions. So both of these guys, they're choosing how safe they want to be and also how costly it is for them, right? So now they're still trading off these two frictions, as we saw the concavity, right? So there is some tension there, but they're also doing it in relation to each other. Okay, so at this point, nobody is offering the T0 because they're both happy, they're competing, they each have half of the market, as I will show you later, and they can exert market power in their own section, okay? If you try to shift the level of the market of this counterparty risk variable, delta, right, which is kind of common for the two guys, that was the ex ante parameter that we set. So if the markets become more risky, they are still evenly matched. So my co-author Marius here likes to do this boxing analogy, and maybe I try to do that as well. So they're competing, right? They're trading off their strong points and their weak points, but they're still evenly matched, even if kind of the delta shifts. So they're still sharing half of the market, but in some sense, as market becomes more and more risky, the counterparty risk increases, the high quality guy gets a latent advantage because at some point there will be flight to quality and more and more people will want to settle immediately, okay? So this advantage didn't really kick in yet, but it will kick in the immediate settlement equilibrium, and this is this case. So here we have two intermediaries, one offering T0 and the other offering delayed settlement. And here this evenly matched situation actually collapses because what happens is as we shift the market risk, right, there is this flight to safety, and it basically, with the boxing analogy, it kind of tilts the ring to the favor of the high quality or the better player. And with the immediate settlement equilibrium, basically the competitor is pushed to the corner. Why is that? Why does this analogy even make sense? Well, because the high quality intermediary is already maxed out on his cost. So he already went full way for his competitor, and he also delivers the best possible service there, okay? So he starts winning more and more market share as markets become more risky, and his competitor starts losing the market share, right? So this is really like he cornered his competitor, and now it's just gonna get worse and worse for the other guy, and as I will show you. And this is the case when we shift delta. Again, there is already T0, there is already best quality offered on the market, so the other competitor can just try to catch up and with his arrival, but he doesn't really manage to. So in terms of market shares, this is what I was referring to earlier, is the situation is equally matched at the beginning. They share the market half-half with the delayed settlement equilibrium, but then at this corner situation, that's it for the lower quality. He starts losing his market share slowly but surely, and the higher quality guy starts getting more and more market share. The thing that I want to point you out here is very interesting, is this red line here. And this red line shows us how many, or what would be the demand, or how many buyers would actually want immediate settlement in this first best scenario. And you see that this red line is way below the green line. So if we have this competitive scenario, there is overproduction of immediate settlement. There is too much of it. Buyers in the first base, in the ideal scenario of the social planner, they wouldn't want it, but they get it anyway, precisely because of this competition between the two intermediaries. And here we have the profits, and the profits are also interesting. So notice here they're the same at the beginning when we have this delayed settlement, and as soon as T0 kicks in, because the market share of the high quality intermediary grows, his profits grow. But what's salient and kind of a little bit scary here is that these profits actually increase with counterparty risk. So if markets are more risky, intermediaries actually like this, because this gives them, intuitively, this gives them more potential to differentiate and offer these different contracts and earn higher profits. So this kind of gets you thinking about risk management incentives. Will the risk be just kind of shifted to the CCPs? And it's not really good to have this kind of scenario. So now, finally, let me briefly tell you about the alternative. And the alternative is that it's actually the exchange or the trading platform that tells, okay, no, today, for this particular stock, this is the time to settlement, right? It's either T0, T+3, or something else. Well, then this whole competition that was on the time to settlement is just basically killed. And the only way the intermediaries can compete is on prices. And what happens when they compete on prices? They compete Bertrand style, set price equal to marginal cost, and the two contracts that are offered are identical. Okay, so the intermediaries don't earn any profits. And how would the exchange set this time to settlement? Well, it would set it to maximize the total surplus, right? The kind of the total surplus from all these trades. Or alternative, you can think about it, the exchange sets it to maximize the gains for the median valuation buyer, okay? So we solve for this time to settlement, and then we're curious, okay, how does it compare with what these guys were setting before? Is it going to be longer or shorter now? Well, actually, so this graph shows you the green line. That's the fixed time to settlement. And it's fixed in a sense that it's fixed for a particular stock, a particular day, but it's not fixed forever or like for years like the T+3 we have now, okay? So this fixed one is actually below the blue line. And what's the blue line? The blue line, we take these two TH and TL, the two contracts offered, and we weigh them with the market shares or with the demands, right? So we kind of have this average demand-weighted time to settlement. And it's actually higher. So you have two things going on. You have the overproduction of immediate settlement, but you also have this big dispersion in these contracts. So it's like if you make the analogy of watches, you have the market where you would like kind of an okay, lagom watch, okay? But you get either Rolex or something very cheap and very bad, okay? So this competition doesn't really play off well for the median buyer. And finally, the last graph that I will show you, of course, we, as economists, from this kind of design perspective, we want to see the welfare, right? So if we kind of pool the utilities of all the agents in our economy, what will be preferred, right? If you take this the social planner stand. And you see here that the green line is the red line is the best. That was this first best scenario where basically each buyer gets an individual contract, okay? We had this situation in the beginning. Then if we have the exchange set time to settlement, that's the green line, that's kind of second best. The green line over here, this is second best. And the blue line with the competition and the profits maximization of the intermediaries is the worst in terms of welfare, okay? So to wrap up and to conclude, the most important message that we want you to kind of get away from this is, even if you forget all the details about the model, this rigidity of the time to settlement is actually a deeper problem than its length, okay? We should really be thinking about flexibility because it allows much more options here. Immediate settlement, not always optimal, only when things are really bad. And once you have this embedded option, it's not really good because intermediaries exert higher rents, okay? And they exert it on, like, from the buyers, okay? So we really advertise this exchange set potentially dynamic as a function of market conditions, but fixed by exchange or by a trading platform time to settlement. Okay, thank you very much for your time.